We're done with part A and B. Let's move to part C of this question. Sunny Limited is analyzing two options on how to expand its operations. The following data relates to two options. So we have option A and option B. So we have fixed cost for option A, selling price per unit for option A and B, variable cost per unit for option A and B, the expected sales for option A and B. Then the next page reads, required, Roman 1, contribution margin per unit, 3 marks. Roman 2, the break-even point for both options, 3 marks. Roman 3, the operating income under both options. Number 4, we have advise Sunny Limited on which option is more favorable. Advise Sunny Limited on which option is more favorable. That is the question. So we are first of all to contribute the contribution. Part A of the question reads contribution margin per unit. Contribution margin per unit. This is part C. Contribution margin per unit. That is Roman 1. So we can have this thing in a table. We have contribution margin per unit. We can have the formula there. Contribution margin. There are two ways of answering this. I'm thinking of a better way that instead of just answering it straight away, you can have it. You can have this solution in form of a table. You can have it in form of a table. So we have the requirement here. For example, here we have contribution margin per unit. What is the formula? The formula of contribution margin per unit is selling price per unit minus variable cost per unit. That is the formula. So we have contribution margin for product A. Product A. Is it product A? Option A. It's called option A. Option A. And there is option A, option B. Selling price per unit. Contribution margin ratio is equal to selling price per unit minus variable cost per unit. For option A, the selling price is 150. The variable cost for option A is 90 shillings. And therefore, the contribution margin per unit is 60 shillings. Option B, the selling price per unit is 150 shillings. Variable cost per unit is 75 shillings. So 75 deducted from 150, this is equal to 75 shillings. Then Roman 2, what is required for Roman 2? Roman 2, we have to calculate the break-even point for both options in units. Okay. So break-even point in units. This is break-even point in units. The break-even point in units we know is equal to the fixed cost over contribution. Fixed cost over contribution margin. That is the formula for the break-even point in units. So from the question we read, option A, fixed cost is 200,000 shillings. This is 200,000 shillings. We divide by the contribution margin, which we calculated here, is 60. So I'll get my machine. 300,000 divided by 60. 200,000 divided by 60. This is equal to 3,333 3,333 units. Let's do the break-even point for option B. The break-even point for option B, the fixed cost option B is 280,000. 280,000 divided by the contribution here is 75. So I take my machine again and punch in 280,000 divide 75. So I'm getting here 3,000. This is 3,733 units. To break even, option A requires 3,333 units to break even. Break even is a point where profit is zero. So option A will break even when 3,333 units are produced. Option B will break even when 3,733 units are produced. Then Roman 3, the operating income under both options. Look at Roman 3, operating income. 3, operating income. How do we calculate the operating income? Look at the question. What information do we have? We have expected sales. So our operating income, we will determine it by using the expected sales. We'll multiply the contribution margin per unit times the expected sales, then we deduct the fixed costs. So the formula for operating income will be the contribution margin per unit times the expected sales, deduct fixed costs. This is contribution margin per unit times the expected sales. We have the expected sales in units. The expected sales we have from the question in units. We deduct the fixed cost. So the contribution for option A, we have it here. This is 60 shillings times expected sales. From the question, expected sales is 6,000 units. The company is expected to sell 6,000 units. This will give us the contribution. Then we deduct the fixed cost for the option A, which is 200,000. 200. How much is it? This is 60 times 6,000. 200,000. This gives me how much? 60 times 6,000. This gives me, how much is this? The expected sales is 6,000. So let me take it again. 60 times 6,000. What is the fixed cost? The fixed cost is 200,000. The fixed cost is 200,000. Fixed cost is 200,000, which is equal to, this gives me 160,000. That is the operating income for option A. For option B, the contribution is 75. The company is expected to sell again 6,000 units. That is the total contribution. We deduct fixed cost of 280,000. So I have 75 times 6,000 minus 280,000. So this is equal to 170. Operating income, option A, 160,000. Option B, 170,000. I'm moving on well. Are you following, candidates? You need to memorize the formula. For you to be able to answer such a question, you have to have this formula in your head. Formula for contribution margin, formula for break-even point is a formula for operating income. Operating income, we take the contribution margin per unit, we multiply by the number of units. For option A, 6,000, option B, 6,000, we get the total, then we deduct this cost to arrive at the operating income. Then what else is required from this question? Roman 4, advise the company on which option is more favorable and why. Definitely option B is more favorable. Number 4, option B is more favorable because it has, or it promises, a higher operating income of shillings 170,000. You see, this one is higher than the 160,000 because companies are in business to make more income. If option A promises 170,000 shillings, option B promises 160,000 shillings, it's better to take the one that promises a higher operating income. So that is it, candidates, for today's lesson, in which you have answered the question that was tested in August 2025, question 4. We will continue to provide more solutions to these questions. If you have any queries, feel free to ask your questions, and all your questions will be answered. Bye-bye.